Welcome to Wealth Horizons, where we know wealth is more than money. It includes your health, independence, well-being, and freedom to make your own choices. When you are retired, your investments have a difficult job. They may need to generate income, preserve the savings you worked decades to accumulate, and continue growing enough to help offset inflation. Today, we examine 5 low-cost index funds that seniors may want to research: BND, SCHD, VTV, VOO, and VTINX. These are not 5 funds everyone should automatically purchase. Several overlap, while one is designed as a complete portfolio. We will explain the potential purpose, 3 reasons to consider each fund, its important risks, and illustrative allocations for different retirement stages. All investments can lose value. Fund expenses, holdings, and yields change. Review the current prospectus and consult an appropriately qualified financial professional before investing. The first fund is Vanguard Total Bond Market ETF, ticker symbol BND. BND tracks a broad collection of investment-grade, taxable United States bonds. Reason 1. Diversification. Instead of selecting individual bonds, BND spreads your investment among thousands of government, mortgage-backed, and corporate securities. Reason 2. Income. The bonds generate interest that the fund distributes to shareholders. That income is not guaranteed, and the amount can change, but bonds can provide a different income source from stock dividends. Reason 3. Reduced stock market dependence. BND will fluctuate, particularly when interest rates change, but it will not normally move exactly like an all-stock portfolio. That can help moderate overall volatility. BND does not guarantee preservation of principal. Rising interest rates can reduce bond prices, and inflation can reduce the purchasing power of bond income. The second fund is Schwab U.S. Dividend Equity ETF, ticker SCHD. SCHD tracks the Dow Jones U.S. Dividend 100 Index. Reason 1. Dividend focus. It invests in established American companies selected under an index methodology, emphasizing dividend quality and sustainability. Reason 2. Company quality screening. The index considers financial measures intended to identify comparatively strong, dividend-paying businesses. Reason 3. Low operating cost. Its expense ratio is substantially lower than that of many actively managed income funds. SCHD remains a stock fund. Its price can fall substantially, and companies can reduce or eliminate dividends. Dividend income should never be described as guaranteed or as a substitute for a complete withdrawal plan. The third fund is Vanguard Value ETF, ticker VTV. VTV tracks an index of large American companies classified as value stocks. Reason 1. Exposure to established businesses trading at value-oriented measurements rather than concentrating solely on rapidly growing companies. Reason 2. Diversification across hundreds of large-cap value stocks and numerous industries. Reason 3. Very low fund expenses, leaving more of the investment return in the shareholder's account. VTV can still hold technology companies, and value stocks can experience significant losses. It should not be presented as a safe or guaranteed low-volatility fund. The fourth fund is Vanguard S&P 500 ETF, ticker VOO. VOO tracks the S&P 500 index and provides exposure to approximately 500 leading American companies. Reason 1. Broad, large company diversification in one fund. Reason 2. Long-term growth potential. Retirees may still face a 20 or 30-year investment horizon, so an appropriate stock allocation can help address inflation and longevity risk. Reason 3. Extremely low operating expenses. VOO is not a capital preservation fund. It can suffer major losses during bear markets. Money needed for near-term expenses generally should not depend entirely on stock market performance. The fifth fund is Vanguard Target Retirement Income Fund, ticker VTINX. Unlike the first four choices, VTINX is designed as a diversified portfolio by itself. Reason 1. It combines domestic and international stocks and bonds through underlying index funds. Reason 2. It maintains a conservative allocation of approximately 30% stocks and 70% bonds, although the precise percentages can vary. Reason 3. It automatically rebalances, making it attractive to an investor who wants a hands-off approach at a relatively low expense. Here is the important distinction. VTINX should not be placed entirely in the bond column. It already owns both stocks and bonds. Combining it with VOO, VTV, SCHD, or BND changes its intended allocation and can create unnecessary overlap. So, should a senior own all 5 funds? Usually that is not the right question. VOO, VTV, and SCHD overlap because they own many large American companies. A retiree might use one broad stock fund as a core holding and add a smaller dividend or value position for a deliberate reason. BND can serve as a broad bond component. Alternatively, someone seeking simplicity might research VTINX as a complete stock and bond portfolio. Let's finish with educational allocation ranges by retirement stage. For ages 60 through 69, an illustrative range might be 50% to 60% stocks, 30% to 40% bonds, and 5% to 10% cash. For ages 70 through 79, it might be 35% to 50% stocks, 40% to 55% bonds, and 5% to 15% cash. For ages 80 and older, a more conservative illustration might hold 20% to 40% stocks, 45% to 65% bonds, and 10% to 20% cash. These are starting ranges, not instructions based on your birthday. A healthy 82-year-old with a pension, modest withdrawals, and heirs may reasonably hold more stocks than a 62-year-old who depends heavily on portfolio withdrawals. Your proper allocation depends on Social Security and pension income, spending needs, health, expected longevity, taxes, emergency reserves, risk tolerance, and your ability to withstand a major market decline. Cash should generally be held in an appropriate savings or cash equivalent account, not confused with BND. Bonds can fall in value and are not the same as insured cash. The central lesson is not to chase whichever fund recently produced the highest return. Build a portfolio around 3 retirement needs: sufficient income, acceptable protection against major losses, and enough growth to maintain purchasing power. Tell us in the comments, do you prefer managing separate stock and bond funds, or would you rather use an all-in-one retirement income fund? If this video helped you, please like it, subscribe to Wealth Horizons, and share it with someone reviewing their retirement portfolio. Thanks for watching, and we will see you in the next video.